The reason why so many people fail with this type of dividend investing is because they look at something that's paying out a 3 or 4% dividend yield and they say, well, I'd have to invest millions of dollars to make a solid stream of income, so it doesn't really make sense for me to go out and invest in these dividends because I'm never going to actually have the type of money, so it's never going to work. But that's not the way that you succeed with dividend investments, because the thing you have to remember with your dividends is a couple things. Number one, you want to see asset appreciation, which is the growth in the value of your investments. Number two, you want to see dividend appreciation, which means you want to be investing in a good company that's also increasing how much money they're paying you. And then you also want to be reinvesting the dividends that you get. That way now you have a two-pronged approach. You are working to invest your money into this dividend-paying thing. And so now you're working your job, you're working your business, you're getting paid, and every week, every 2 weeks, every month, you're putting money into this fund. Then every quarter, you get paid with a dividend. Now, if you take this money that you're getting paid with dividends and you reinvest it back here, now it's not just you working to grow how much money you have working to bring you dividends, but your money is also working to buy you more cash flow. This is called DRIP, a dividend reinvestment program or dividend reinvestment plan, where now you are working to reinvest the dividend money back into your funds. This is how you can start to scale the amount of money that you can make from dividends, because now, number one, you are working to invest your money into a good investment. That's the key. Sometimes you see people, or a lot of times, get very enticed by a high dividend paying company or fund. Oh my God, this company is paying out a 12% dividend yield. It looks amazing. But that dividend yield doesn't give you the full picture. And you should never invest into a company just based off of what the dividend yield is. Because if that company has fallen by 50% and the dividend hasn't changed, well, yeah, the dividend might look abnormally high, but maybe the company's on the way to bankruptcy. So you want to focus on what the underlying asset is. You want to be investing in a strong company, in a strong fund, in a strong foundation, because that's going to give you the asset appreciation. That means that, number one, the value of your investment will be growing. And if the value of investment is growing, that also probably means that this company, this fund, is making larger profits. And if they're making larger profits, that means that your dividends would also be growing as well. So if you buy shares in a company today, hopefully it'll be paying you even more money next year, even more money the year after that, even more money the year after that. So every year you're working to accumulate more shares, and every year those shares pay you more and more dividends. And then every time you get paid in more dividends, you can reinvest those dividends. This is how you can win in this strategy, even if you don't make a ton of money, because now you're following what I call CPA. You're being consistent, passive, and you have an automatic investing strategy where now you set a system every week, every 2 weeks, or every month. You work to buy these funds, and now it's consistent and passive. You don't change this if the markets go down. You don't change this if you enter a recession. You don't change this if the markets are booming. The only time you would change it is if markets go down. You could use it as an opportunity to buy even more and buy more aggressively. That's how you win. Because now if you stick with this, well, now you can see that small amounts of money will start to compound after years of doing this. Now the key here is you gotta anticipate doing this for multiple decades. Because if you plan to do this for just 2 years, you're gonna fail. I call it a decade of sacrifice to start building a wealth, because the first few years of you investing into anything, especially dividend paying funds, you're gonna see no returns because you're just getting started. I mean, unless you are somebody who has $1 million given to you in a trust fund, then you could take all $1 million and invest it. But for most of us, we don't have that. So you gotta start with something. Maybe you start with $100 a month. And so when you start with $100 a month or $100 a week or whatever it might be, you don't start to see many returns the first few years. But then year 4, you start to see a little bit more of a significant return. It might not be huge, but you start to notice that, hey, I'm making a decent dividend. Because now not only have you been working to invest your money into these funds, but your funds are also buying you more funds because you're using a cash flow to buy more funds. So year 4, year 5, year 6, and year 7, it's a decent amount. And then you go to year 8, and now all of a sudden, you're starting to get a little bit more of a sizable check. And now every time you're working to get a pay raise, you keep investing more money, and now your dividends are also paying you more money, and now you can buy more shares of these funds, which buy you even more cash flow. And now by year 10, all of a sudden, you have a whole new stream of income that you could use to help supplement your lifestyle, Or if you want to stay consistent and really build a strong stream of cash flow that can fund you an even bigger lifestyle, you can keep doing the dividend reinvestment plan, where now you just keep reinvesting your dividends while also working to buy more cash flow. And that's how your wealth is built with this system. You start with a little bit, you keep doing it. As you get more money, you keep investing more money, and then as your dividends make you more money, you stick with it. You stick with it for a while, because if you put in the time, well, now you can start to see the returns. But you have to have a long-term horizon. If you're planning to do this for just 2 years, you are going to fail. The reality is we're going to see market crashes. We're going to see a recession. Our economy has seen a recession every decade for the last 100 years. We're going to see more market crashes. You have to give yourself time to withstand these recessions. You have to give yourself and the economy time to grow and rebound and to capitalize on the changes that our economy goes through. And that's why you have to have the long-term horizon. That way, even if you don't have a ton of money to invest, even if you're starting with just $100 a month, you can still see those gains, but you have to stay consistent. Now, the last thing that I want to mention about this is, as people start investing, one common thing that happens is you say, oh, I'm starting to like this investing thing. I'm starting to understand that if I keep doing this for the long term, I can build real wealth. I can build true generational wealth that my family never had before. And it's an exciting feeling. And then the next question is, how can I get there faster? And the thing you don't want to do is start getting into more risky investments, because then you can get caught up in get-rich schemes and take yourself back 5 years of investing. But what you want to understand is how you can invest more aggressively. And at the end of the day, there are two things you can do. You can either work to spend less money, or you can work to earn more money. And so now the question is, well, how do you do that? There's a limit to how much you can cut back on, but there's no limit to how much you can earn. So yes, in the beginning, you might want to cut back. Find ways to drive a smaller car or a less expensive car, live in a smaller home, go on less vacations, eat out less, find ways to cut back on your expenses. But at the end of the day, there's a limit to how much you can cut back, but there's no limit to how much you can earn, because I want you to have the nice things. I mean, the reason why you work so hard to be financially smart is so you can fund all the nice things that you want. I just want you to be able to afford the nice things. So I am not against you going on expensive vacations, buying expensive things, driving lavish cars. No problem with that. Just make sure you can afford it. There's no limit to how much you can earn. Now, there's a lot of ways you can earn more money. You can work to earn more money at your job, ask for a raise. You can work to get a second job. You can work to get a career change. You can work to get a new job. Or you can work to start a side hustle or your own business. Now, again, this is going to take more work, but the key is, as you make more money, to invest more money as well, because that's what's going to allow you to grow and scale this wealth. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.